This second presentation deals with contributions and using contributions to a superannuation fund as a tax deferral mechanism. I don't expect this to be used quite frequently, but for those who are in the top marginal tax rate, this will be something good for them. And so tax deferral is the second of the points that I'll be covering. The next presentations will deal with in specie and in-house assets and borrowing contributions. So this stratagem deals with the concessional or the deductible contributions for income earners that are in the highest tax bracket, that is, those who are in the 46 cents of the dollar tax bracket. The advantages are that the deferral of the lodgement of the self-managed super fund tax at 46.5% to 10 months. In other words, we can lodge the superannuation fund tax return 10 months after the end of the financial year. The super fund would be levied 15% tax immediately, and then a further 31.5% would be levied by assessment in another 6 to 8 months' time. And so it's not avoiding tax, it's just deferring the tax. Now, the superannuation fund has the use of the contributions for 12 months, deriving investment earnings for over that period before the bulk of the tax is paid. So that's a plus for the fund. It's not avoiding tax, it's just deferring it. So the superannuation fund has got the capacity to utilise those assets to its profit. The super fund doesn't need to pay the excess contributions tax, as this can be paid by either the member or the fund. So this is often used as a mechanism to get extra assets into the fund. It's a way to get around some bankruptcy issues and ATO interest on free debt repayment. In other words, you can put the excess contributions into the super fund. It will then pay the normal 15% tax in May, and then a further assessment, as we specified before. A further assessment will come probably around December the following May for the other 31.5% tax. And so then when that is received in, say, the December, or in other words 18 months past, it's possible then to enter into an arrangement with the ATO to have the debt repaid over a period of time. And under Mr. Rudd's reforms at the moment, it's even possible to negotiate that debt to be a tax-free debt and make a repayment over the next 12 months. So not only is it tax deferral, but also you can make a payment deferral system interest-free, provided that provision stays alive by the current government. There are a couple of traps. Don't exceed the contribution caps in both concessional and non-concessional in the same year. You can exceed them in the concessional area or the non-concessional area, but certainly don't do both. You get hit under Part 4A if you did that. And of course, don't exceed contributions cap in consultative years. In other words, not 1 year following the next, don't make a habit of it. In summary, the 2010 federal budget sought to give the Commissioner some discretion in relating to the application or applying of tax on excess contributions. He didn't have it before. He's now been provided with it in this budget, so some of the circumstances may change where we can defer the payment even more, asking the Commissioner to exercise his discretion. So that's the end of this presentation. We'll now go on to the next one. Thank you.